A. Explanation of cash flow. Cash flow is the amount of cash that flows in and out of a business during a specific period. It is the difference between the amount of cash received and the amount of cash paid out. Positive cash flow means that the business is receiving more cash than it is paying out, while negative cash flow means that the business is paying out more cash than it is receiving. B. Importance of managing cash flow for business success. Managing cash flow is critical for business success because it affects a company's ability to pay its bills, invest in new opportunities, and grow over time. Even profitable businesses can fail if they don't have enough cash on hand to cover their expenses, and managing cash flow is essential for ensuring that a company has enough liquidity to weather any financial storms that may come its way. Effective cash flow management also allows businesses to identify areas where they can cut costs, optimize their cash reserves, and make strategic decisions about investing in growth opportunities. In short, managing cash flow is essential for the financial health and sustainability of any business. Understanding cash flow. A. Definition of cash flow. Cash flow is the movement of money into and out of a business. It is the amount of cash that is generated or consumed by a business during a specific period, usually a month or a quarter. Positive cash flow occurs when a business brings in more cash than it spends, while negative cash flow occurs when a business spends more cash than it brings in. B. Cash flow statement overview. A cash flow statement is a financial statement that shows the cash inflows and outflows of a business over a specific period. It includes 3 sections: operating activities, investing activities, and financing activities. The operating activities section shows the cash generated or consumed by a business's operations, such as sales, purchases, and expenses. The investing activities section shows the cash spent or received from investments in assets like property, plant, and equipment. The financing activities section shows the cash spent or received from financing activities like loans, equity issuances, and dividends. C. Difference between cash flow and profits. Cash flow and profits are not the same things. Profits are the difference between revenues and expenses, while cash flow is the movement of cash in and out of a business. A business can have positive profits but negative cash flow if it has a lot of outstanding invoices or inventory on hand that it has not yet been able to sell. Alternatively, a business can have positive cash flow but negative profits if it is selling assets or taking on debt to generate cash. In short, cash flow and profits are different metrics that should both be monitored to ensure the financial health of a business. Monitoring and forecasting cash flow. A. The importance of forecasting. Forecasting cash flow is important for businesses because it allows them to predict their cash flow needs in advance and plan accordingly. Forecasting helps businesses to anticipate potential cash flow shortfalls and take steps to address them before they become a problem. Forecasting also helps businesses to identify opportunities for growth and to plan for investments that will require additional cash. B. Ways to forecast cash flow. There are several ways to forecast cash flow, including 1. Historical analysis. A business can analyze its past cash flow patterns to forecast future cash flow needs. 1. This involves examining the business's past cash receipts and disbursements to predict future cash inflows and outflows. 2. Sales projections. Forecasting cash flow based on sales projections is common for businesses that have regular sales cycles. 2. A business can predict future cash flow based on expected sales, customer payment terms, and sales trends. 3. Expense projections. A business can forecast cash flow based on projected expenses. 3. This involves estimating future expenses based on historical data and expected changes in expenses, such as increases in rent, salaries, or utility costs. C. Software options for forecasting. There are several software options available for forecasting cash flow, including 1. Accounting software. Many accounting software programs include cash flow forecasting features. 1. These features allow businesses to create cash flow statements, analyze past cash flow trends, and predict future cash flow needs. 2. Financial planning and analysis, FP&A, software. FP&A software is designed to help businesses forecast financial outcomes, including cash flow. 2. This software can integrate with accounting and other business systems to provide a comprehensive view of the business's financial health. 3. Cash flow management software. Cash flow management software is specifically designed to help businesses forecast and manage their cash flow. 3. These programs can analyze historical data, provide forecasting tools, and help businesses identify opportunities to improve their cash flow. Overall, monitoring and forecasting cash flow is essential for the financial health and success of any business. By predicting future cash flow needs and planning accordingly, businesses can avoid cash flow shortfalls and make informed decisions about investments and growth opportunities. Strategies for managing cash flow. A. Accounts receivable management. Accounts receivable management is a strategy for managing the money owed to a business by its customers. To effectively manage accounts receivable, a business should 1. Set clear payment terms. Establishing clear payment terms with customers can help ensure that invoices are paid on time. 2. Invoice promptly. Invoicing promptly after goods or services are delivered can help reduce the amount of time customers have to pay. 3. Follow up on unpaid invoices. Consistently following up with customers who have unpaid invoices can help ensure that payments are received in a timely manner. B. Accounts payable management. Accounts payable management is a strategy for managing the money a business owes to its suppliers and vendors. To effectively manage accounts payable, a business should 1. Set payment terms. Setting payment terms with suppliers can help ensure that bills are paid on time and avoid late payment fees. 2. Monitor payment due dates. Tracking payment due dates can help ensure that bills are paid on time and avoid late payment fees. 3. Negotiate payment terms. Negotiating payment terms with suppliers can help reduce the amount of cash that is tied up in accounts payable. C. Inventory management. Inventory management is a strategy for managing the goods and materials that a business has on hand. To effectively manage inventory, a business should 1. Monitor inventory levels. Regularly monitoring inventory levels can help ensure that a business has enough inventory to meet demand without tying up too much cash in unsold goods. 2. Optimize inventory turnover. Reducing the time it takes to sell inventory can help free up cash that is tied up in unsold goods. 3. Reduce inventory costs. Reducing inventory costs, such as storage fees and spoilage, can help increase cash flow. D. Cash reserves. Maintaining adequate cash reserves is a critical strategy for managing cash flow. Cash reserves can help a business cover unexpected expenses or weather temporary cash flow shortfalls. To effectively manage cash reserves, a business should 1. Establish a cash reserve target. Setting a target for the amount of cash to be held in reserve can help ensure that a business has enough liquidity to cover unexpected expenses. 2. Regularly review cash reserves. Regularly reviewing cash reserves can help ensure that they are adequate and adjust them as needed. 3. Invest excess cash. Investing excess cash in low-risk, high-liquidity investments can help earn additional income while maintaining adequate cash reserves. Overall, effective cash flow management is essential for the financial health and success of any business. By implementing strategies for managing accounts receivable, accounts payable, inventory, and cash reserves, businesses can optimize their cash flow and make informed decisions about investments and growth opportunities. Increasing cash flow. A. Sales strategies. Sales strategies are a key component of increasing cash flow. To increase cash flow through sales strategies, businesses can 1. Offer discounts. Offering discounts for early payment or bulk purchases can encourage customers to pay quickly and help improve cash flow. 2. Increase prices. Raising prices can increase revenue and improve cash flow, but it's important to ensure that prices remain competitive. 3. Expand sales channels. Expanding sales channels, such as online sales or partnerships with other businesses, can help increase revenue and improve cash flow. B. Reducing costs. Reducing costs is another strategy for increasing cash flow. To reduce costs, businesses can 1. Negotiate with suppliers. Negotiating with suppliers for better prices or payment terms can help reduce costs and improve cash flow. 2. Streamline operations. Streamlining operations, such as reducing unnecessary expenses or improving production efficiency, can help reduce costs and improve cash flow. 3. Outsource non-core functions. Outsourcing non-core functions, such as accounting or IT, can help reduce costs and improve cash flow by allowing the business to focus on core functions. C. Financing options. Financing options can also be used to increase cash flow. Some financing options include 1. Business loans. Business loans can provide a lump sum of cash that can be used to increase cash flow. 2. Invoice financing. Invoice financing involves selling unpaid invoices to a third-party company for a fee, which can provide immediate cash flow. 3. Merchant cash advances. Merchant cash advances involve receiving a lump sum of cash in exchange for a percentage of future credit or debit card sales. Overall, increasing cash flow is essential for the financial health and success of any business. By implementing sales strategies, reducing costs, and exploring financing options, businesses can optimize their cash flow and make informed decisions about investments and growth opportunities. Case studies. A. Examples of businesses with good cash flow management. 1. Apple Inc. Apple has consistently demonstrated strong cash flow management, with a cash balance of over $200 billion as of 2021. 1. They achieve this through strategic investments and strong operational efficiency, such as effective inventory management and timely collection of accounts receivable. 2. Amazon.com Inc. Amazon is another example of a company with excellent cash flow management. 2. They generate significant cash through their retail operations and reinvest it into growth opportunities, such as expanding their product offerings and building out their logistics infrastructure. B. Examples of businesses with poor cash flow management. 1. Toys R Us. In 2017, Toys R Us filed for bankruptcy due to a significant cash flow shortfall. 1. The company had failed to adapt to changing consumer trends and had significant debt burdens, which made it difficult to maintain adequate cash reserves. 2. Kodak. Kodak is another example of a company that struggled with cash flow management. 2. Despite being a market leader in the film and camera industry, they were slow to adapt to the digital photography revolution, which led to declining sales and cash flow issues. In both of these cases, poor cash flow management ultimately led to significant financial challenges for the businesses. Effective cash flow management is essential for the financial health and success of any business, and it's important for businesses to prioritize and invest in these strategies to avoid similar challenges. A. Summary of key points. In summary, managing cash flow is critical for the financial health and success of any business. It involves monitoring and forecasting cash flow, implementing strategies for managing cash flow, and exploring ways to increase cash flow. Effective cash flow management can help businesses make informed decisions about investments and growth opportunities, avoid financial challenges, and achieve long-term success. B. Importance of ongoing cash flow management. It's important to note that cash flow management is an ongoing process, not a one-time task. Businesses should regularly monitor their cash flow and adjust their strategies as needed to maintain financial stability and optimize cash flow. C. Encouragement to take action and implement strategies. As a business owner or manager, taking action and implementing effective cash flow management strategies is critical for the success of your business. By understanding the key concepts and strategies for managing cash flow, exploring financing options, and prioritizing ongoing cash flow management, you can optimize your financial health and position your business for long-term success.